Okay, so last training session was geared a little bit more for folks that work for me in my brokerage. We talked about our company name, the meaning behind it, what basically our mission statement is, and what our philosophy is, why we do what we do, why I do what I do, and how I came to do it that way. So today we're going to jump into some real kind of heavy in the sense that if you have not done this before or you don't have much experience in it, it's going to be a lot today. We're going to go over a lot of acronyms and mortgage terminology today. Listen, my intention with this today is not to teach you everything about the terminology, and certainly not for you to memorize it. If you think about like learning a foreign language, if you took like a foreign language in high school class, like you didn't learn the whole language the first day or the first week or even the first month. You learn things like, where is this language spoken? You start with really simple things. And so today we're going to go over terminology. My intention is to simply bring exposure to the terminology and the acronyms. There were a lot of these acronyms that I didn't hear right away from the very beginning in mortgage. But what I find is that, you know, in my experience, I was always very ego afraid to ask the questions. I felt like a lot of times it was stuff that I should know, and there really wasn't a good place of reference. Now you have to remember, back when I started in mortgage, the internet and things like Google and YouTube and all those things were still developing or hadn't even existed then. So we didn't have the resources available that we do now. But I want to go over the acronyms. We're going to spend a decent amount of time in that today. And then we'll talk about mortgage math, and then we're going to just do some basic loan matrices. We're filming this during COVID, and so there are some different parameters for lending, but what I want to do is teach the basics as they are prior to any lender overlays, and we'll talk about what an overlay is, and we'll do all of that. My intention really is to give you the exposure. So that way, the next time that you come and hear this, you're going to be like, oh, yes, I remember that was in that training class that I took, and it was in the acronym sheet. We're going to find ways to get these sheets and all this really helpful information to you. But for today, we're just going to go over the acronyms. We're going to screen share. And so we're just going to jump right in. So give me a second here. Let's see, screen share. I'm getting really good at this, but I'm not great at it yet. Okay, acronyms. So here's our list. I'm just going to go in alphabetical order. It is going to take some time. If you want to take some notes about some of these, that's fine. But I will find a way to get this to you as well. Okay, so starting with A. So this first one, we actually don't typically see it as AAMC. People don't really say it that way either. We just call it an AMC. It's an appraisal management company. So a little bit of background on this one. Before the housing crisis of 2008 to 2012, there weren't any regulations in ordering appraisals. You could have realtors and lenders could have a relationship with appraisers, and we could say, hey, you know, we really are looking for this property to appraise for X amount of dollars. And of course, you know, if that's an appraiser's livelihood, and I'm not saying appraisers are bad, that's not what I'm saying, I'm just talking about how things used to be. In order to keep that business coming, an appraiser would do a really good job making sure that that value was reached, even if it was a stretch. And so what happened as a part of the housing crisis from 2008 to 2012 was the creation of appraisal management companies. Now listen, before I go any further in this, you're going to hear me say this a lot throughout my trainings, which is I am not always going to come at you from a compliance measure or technical verbiage. My intention in doing these is to give you everyday examples and use everyday language that's easy to understand so that you can take the things that you know, the skill sets that you have, and bring them into this industry. So if you're somebody that's in this industry, please don't attack some of the things that I say, because I'm really trying to bring this down to the most basic common level of understanding for the majority or for the biggest amount of people who could watch this and gain something from it. So that being said, this was derived out of, one of the results of coming out of the 2008 to 2012 housing crisis. And so now what happens is a loan officer has to place a request with an appraisal management company. The appraisal management company alerts or sends out a notice that there's an order to fulfill. I'm also a notary in my state, so the same thing that happens for any sort of notary stuff, I get like a text message saying that there's a request for a notary in this specific area at this specific time. And so what happens is that we don't get to choose. We don't get to choose what appraiser goes. It's a very organic process. And that process was created in order to keep the valuation of properties as organic as possible without influence from a lender or a real estate agent. And so the entity that oversees that is called an appraisal management company or an AMC. Okay. So the next one is AMI, area median income. You can Google search this. It's what's determined. I don't know the science behind it or the math behind it, but it's done by state and county of what the average or area median income is. The reason this is important are there are certain loan programs that in order to qualify for them, you can't exceed the area median income. One of the big changes that happened earlier this year in 2020 was that Freddie Mac and Fannie Mae has two low down payment loans. They're called affordable loan products. A lot of times they're characterized as first-time home buyer products. They allow 3% down, but in order to qualify, you have to be someone who earns no more than the area median income for the county that the property is in, and that guideline was changed and became very restrictive at the beginning of 2020. But that's what that is. A lot of community lending programs also have this restriction. APR. So APR, the best example that I ever got of this, and to this day, it's still the way that I share it with my clients, is, you know, when a client is getting more than one loan estimate, so an estimate from lender A and an estimate from lender B, but let's say the fees are different. A lot of the numbers are different. They don't jive the same. And so how is someone who doesn't work in the industry, how do they determine if these two estimates are apples to apples or is it an apple to orange? And so the thing that we talk about the most is the APR when it comes to comparing. And so the APR is the way to measure the amount of fees in the financing. And this is true for any kind of financing, whether it's car financing or credit cards. And so what you want to do is that looking at the APR of any sort of financing terms is a way to determine whether or not two or more estimates of a certain kind of loan are apples to apples, right? So, and an APR measures the amount of fees that are financed into the loan or into the product of lending that's being utilized. And it's amortized over a year, and then that's how you get the APR. So the more fees that are financed in, the higher that APR is going to be. One way to tell whether or not you have a lot of fees financed into a mortgage loan specifically is the difference between the percentage rate for the loan and the APR. Now, there are some loans where the APR is significantly high. Well, I mean, significantly is relevance, but the APR is higher than the percentage rate, but that's because the characteristics of the loans themselves. For example, FHA has an upfront insurance premium that the majority of the time gets financed into the loan, so that automatically is going to have a higher APR. Same thing with VA loans with the funding fee. If a veteran is getting a VA loan and they are not exempt from the funding fee, and they are charged a funding fee, which is charged by VA, not by the lender, and that is wrapped into their loan, then on a VA loan, the rate and the APR is going to have a different, they're not going to be the same, because the funding fee typically is added to the loan amount and financed in. So that's APR. An ARM, or adjustable rate mortgage. I'm sure everybody at some point has heard something about this. An adjustable rate mortgage is just a mortgage that adjusts based on pre-specified terms. So for example, here, let's stop screen sharing really quick here. So for example, what you would see, what's typical to see in lending is you would see something like a 5-1 ARM. Okay, so adjustable rate mortgage. 5 means that it's fixed for the first 5 years. And then after that, it will adjust one time per year based on, oh, that darn ring light. We're going to get that figured out one day. But based on a 5-1 arm, so 5-1 arm, it's fixed for the first 5 years. And then after that, it would adjust one time a year. Okay. Sometimes you might see, let's see. I think if I come over on this side of the board, it doesn't catch the ring light. Okay, so you might see like a 5-1-1, and so it will say, so it's fixed for the first 5. Okay, it'll adjust one time a year, and this adjustment has a cap of 1%. Does that make sense? So it's fixed for the first 5 years. It can adjust, it'll adjust one time a year. And this is a 1. I don't know if you can see, there's a little bit of a, let me see, hold on a second. I think that's better. Okay, so it'll adjust one time a year, and then the cap that it can adjust is 1%. I don't think I'm going to dive too much into how this adjusts or what determines that it adjusts, but basically all loans, all rates are based on an index. So it's an index, like if you ever have any experience like watching the stock market or watching stocks like that, the Dow Jones is an index. So that would be the most common one that everybody's heard is the Dow Jones. Most loans are made, right here is the light, okay. So most loans are based on the LIBOR, which is the London Interbank Offering Rate, I think something like that, because it tends to be more stable. It doesn't fluctuate as much. But like what would happen is that, let's say the loan was fixed for 5 years, and the loan, at the time the loan was written, let's say the LIBOR rate was 4%, okay? So lots of time has gone by, 5 years goes by, we come into this adjustment period, okay? So let's say at the time we go to adjust after 5 years, let's say the LIBOR has adjusted to 6, okay? The first adjustment is capped to 1% at 5%. Oh, this, you can't really see that, can you? Because that stupid ring light. This is a 4, okay? And converse is true as well. If we come back and the LIBOR, let's say we come back after 5 years and the LIBOR is 2, this is only going to be 3 because it's a max 1% adjustment, good and bad. Okay, so that's an ARM. And listen, ARMs got a bad rap during the housing crisis. They got a really bad rap. And what I tell people is, it's just it's a financial tool, okay? And so every loan is a tool, and we have an objective to do it. And it's not always bad, but typically for me, myself, I don't really do a lot of ARMs because people are very apprehensive about it. And unless they're like a savvy investor or a savvy financier or someone who really is inquisitive about how this works, I just don't really practice it on a regular basis because it gets such a bad rap, and it's really challenging to overcome the media that comes along with adjustable rate mortgages, even though a lot of times they are better for a client. It just is hard to overcome the objections and kind of the bad rap that they were given at the fall of the market in the 2008 period. Okay, so I'm gonna go back to sharing the screen. Okay, adjustable rate mortgage, ATR, ability to repay. You won't come across this very often. A lot of times when you come across it, in my experience, has been on down payment assistant loans. They have something that's called like a max housing increase. And that's when you'll hear this, is like if somebody's going from their current monthly payment to a new monthly payment and they max out the, oh, I'm going to forget the dang word. And I did that last time too. it's like housing shock. It's not the word either. I'm going to remember it in the most awkward time. But anyway, so it's like the amount that the payment that they're currently paying for housing versus the new housing payment goes up. A lot of times, like down payment assistance programs will cap the amount that it can go up from what they're currently paying. And it's because they're trying to preserve their ability to repay. Okay, AUS. You will hear this all day, every day. It is a very highly used word. AUS is automated underwriting systems. Okay, so automated underwriting, AUS, for Fannie Mae loans. And listen, if you don't know what I'm saying, that's okay. My intention is to explain this to you, and then as you become more exposed to some of this stuff, you're going to have something to recall on, and you're going to be able to go back and be like, oh yeah, I heard that. Or when you hear it, you'll be able to understand it more. It's something that we have on our training. We'll dive into it a little bit more. It might be the next training or maybe 2 trainings from now. But anyway, so Fannie Mae, how do I want to say this? And then you have Freddie Mac. Okay, so when we have different kinds of loans, they're backed by different entities. So I think I was talking about this the other day, and it's kind of like, oh, I gave the shoe analogy. That's what it was. Okay, so you have different types of loans. Okay, so you have a conventional loan, you have FHA loans, you have USDA. These are like for properties that are in more rural areas. You have VA loans, you have like what's called non-QM, okay? And then these are like the sponsors, okay? They write the rules. They write the rules and the parameters for which someone can qualify or be approved for this kind of loan, okay? Fannie, underwrite, you run FHA in that. Okay, so each one of these have, okay, and then USDA and VA are Ginnie Mae. And these are like, we call them investor. So they're backed by investors who pour the money into them. So these people write the rules for what is approvable in these kinds of loans. And in order to, like, you're not going to go through every file and pick apart everything about the file. What's going to happen is we're going to upload the file into their underwriting system. Okay, so the automated underwriting system. This one, let's see, for Fannie is DO, Desktop Originator, Desktop Underwriter. For Freddie Mac, it's LPA, Loan Product Advisor. And for Ginnie Mae, it's Gus. And even, oh, sorry, VA is also ran in DU and DO, okay? And then investors don't, it depends. So if an investor loan, and I'm jumping a little bit deep here, but it's only to just give you some exposure and background knowledge. Investor loans, sometimes what they do is they'll say, we like the characteristics of this type of loan, except we'll let you go in a higher, we'll let you borrow more money. So what we want you to do is run the loan here, and as long as it's approved, like prove ineligible, and it says that it's ineligible because the loan amount is too high, then we'll do this loan on those parameters with our own rules on it. Hopefully that makes sense and it wasn't too much thems and this and that, because I always hate when people do that. Sorry. Okay, back to sharing the screen. Okay, AUS, so automated underwriting system. You're gonna run, once a loan file is complete, you're going to upload the file into the underwriting system. It's gonna do its automated underwriting over it to tell you whether or not the parameters as you've submitted it are approvable, okay? AVM, an automated value model. This is the best way that I can explain it would be like a drive-by or a value report given to a property where there isn't an inspection that was actually done. The appraiser didn't go out and actually look at the property. It's getting a little dark in here. Okay. Basis points. This is how loans are priced. And, oh goodness. All right, let's take this off a screen share again real quick. Okay, basis points. This is the currency of loans. If you were ever the person that said in math class, like, why are we gonna learn this? I'm never gonna use it in my whole life. You need to find out if your teacher is still teaching and be like, dear Mrs. Jones, I was so wrong. I'm finally using this math in my life. You're welcome. Okay, so a basis point in lending, basis point, BPS, okay? It's a percentage of 100. Oh, that damn light. I have to get this shit figured out. Let me see. Let's do this. This is so that I know not to write in these areas because the damn lights are in it. It's like drawing a circle around an infection on your arm. Okay, basis points. So basis point is a percent of 100, okay? So when we're doing pricing and loans, and we'll jump into this in another training, but I want you to see it and understand it before you ever do it. So let's say a loan is priced, we're always trying to hit 100, that's our target. Anything above 100 is a credit in pricing. Anything below 100 is a charge, okay? And what you're gonna hear is, you're gonna hear people talk in basis points. So if we have a loan that priced out at 1.125, the way you're gonna hear it is 1 and an eighth, because that's an eighth of 1%. It's an eighth, like if you multiply this times 8, you're gonna get 1, right? Like, oh, you guys, now I'm going down the rabbit hole. Okay, hold on. This first, then we'll talk about eighths. Okay, so if this was our pricing on a loan right here, okay, we would call this 1 and an eighth basis points. Okay. This would be 50 basis points. Okay. Now the reason this is called an eighth is because it's 1/8 of the number 1. It's 1/8 of 1%. So 2 of these makes a quarter. There's 4 quarters in a dollar. If 2 of these make a quarter and there's 4 quarters in a dollar, then there's 8 of these in a dollar, or 8 of those in 1%. Okay. Simple math. It's just how I do it in my head. Okay, so that's the basis point. You will call them, you'll also hear them called BIPs. BIPs is the other way you would hear that said. Okay, jumping back into screen sharing. Okay. KBERS. So KBERS is, and we don't normally see it with the double C there, just the regular C. So KBERS is it is a federal database of names of people who are in default on any sort of federal debt. Now, a lot of times people just think it's student loans, but what I didn't know for a really long time is that if somebody, let's say somebody was getting food stamps or TANF or Medicaid, and they actually for some reason didn't qualify for it, and let's say the county or state government said, hey, we found out you actually didn't qualify for this and you need to pay it back, their name would hit as positive on the KBERS registry. So this is not only just student loans, but it's any federal debt or any federal monies. If somebody was receiving Social Security income and it was found out that they didn't actually qualify and they were required to pay it back and they were in default of paying that back, they would show up on this registry. Now, if somebody is on this registry, they are not eligible to obtain financing that's backed by any of the names that we just talked about over here. Fannie, Freddie, Gus. They're not eligible to get a loan until the default is cured. Okay. CLTV. Oh, let's talk about this. Okay. When you are doing loans, oh, darn it, I erased my circle. Okay. When you are doing loans, one of the main parameters of loan qualifying and loan pricing is loan to value, okay? So loan to value is going to be the amount they're borrowing. So for easy math, let's just say somebody is borrowing $80,000. This is the loan. And the house is worth $100,000. It's the loan to the value, okay? This specific scenario is an 80% loan to value or LTV, okay? Loan to value. Now, see, and I didn't know this, and it's gonna come up on the sheet. Well, I knew this one, I didn't know the next one that's coming up. Okay, so CLTV means combined loan to value. So let's say homie who has this $80,000 loan, let's say the following year, they went and got a $10,000 equity line of credit, or, sorry, home equity line of credit, or a HELOC, right? Let's say the value is still the same. So now their loan to the value, which is this here, is now 90%. They're borrowing 90% of the total value of the home. So their first mortgage is an 80% LTV. The second mortgage now makes it a combined loan to value of 90% LTV. Now I'm going to turn my camera just a little bit more this way. I'm going to squeak a little bit more whiteboard over here. Now, the reason why I hesitated to use this is because the HELOC is a little bit different. This is if you have a true, this is more like if you have a true second mortgage. And then you're going to have what's called an HCLTV. Okay, so we're going to use the same example. So we still have the first mortgage at $80,000. Okay, now the difference is, let's say this guy here was actually, so we have 10,000 charged, okay, but we had 15,000 available. So the borrower was actually approved for 15,000, and right now they've only used 10,000, okay? So the LTV is still going to be 80%, okay? The CLTV, what they actually owe, is going to be 90%, but because they have this extra $5,000 that's available to them, but they haven't used yet, okay? Their HELOC combined loan to value, even though they haven't used it yet, is going to be 95%, right? Because they've got 15,000 here, so 15,000 plus 80,000 is a total of 95,000 available, even if they haven't used it, and that's HCLTV. I didn't know this for a really long time. I didn't know that that's what that meant. Okay, so I would imagine because of the economic effect that COVID is having right now, and the demand that the economy is basically in a demand that rates are going to stay low for a while. And I would imagine that home equity lines of credit for those that are able to maintain their credit profile during this are going to be something of value coming down the line. And so this is something I would maybe anticipate to see a little bit more of as we move on in life. Okay, back to sharing the screen. This always takes me a minute. I wish there was a quicker way for me. Okay, so CLTV, COE. A COE is a certificate of eligibility. There's only one type of loan you're going to use this on, and it is a VA loan, which is a loan for a military person who has either is currently in the military or has been discharged from the military in good standing. They have a benefit available to them, which is going to be outlined on their certificate of eligibility. Y'all, this is really, really important. In my brokerage, my loan officers are not allowed to give an approval until they have a certificate of eligibility in hand. You have to apply in order to get a sponsorship with the Veterans Association as a lender and be able to, so not every broker does this, not every broker has their own credentials. We happen to have ours, and so for my company right now, either myself or my processor orders all the COEs for our company to make sure that they're valid before we do any VA loans with anybody. Okay, so it's going to tell us what the veteran is eligible for and if they have a funding fee that they have to pay or if they're exempt from it. So just know that you need this on all VA loans, and you really should have it up front. CPI, Consumer Price Index, we don't really use that a lot. C2P. Okay, so I've never seen the acronym like this before, but the reason that I want to have it in here is because construction to perm is a true loan. Okay, so it's like a loan for someone who's doing a new construction home, but isn't doing it through like a big builder. This might be like a one-off or semi-custom or custom build, but it isn't like going down to your, I see like Lennar is a big builder in Denver. So it's not, it wouldn't be like going down to like look at all the show homes in Lennar and then buying a Lennar home. You would just get a loan on the final build, and the builder carries the burden of all the expenses to build. So construction to perm would be more of like, let's say somebody is owns or inherited a lot of land, or they bought a lot of land and now they want to build a home on it, and so they contract like a semi-custom builder to build them a home. They would need a construction to perm loan, but I've never really seen it as called a C2P. CRC, you may or may not see this very much, but it is just in reference to your credit reporting company. It's just going to be the company that the credit report is ordered through. There are a number of them out there. The two that we've used in my brokerage are Advantage Credit and Funding Suite. CRV, Certificate of Reasonable Value. This has a lot of different ways to be explained, but it's appraisal related, it's value related. Collateral Underwriter, gosh, you know, we really don't see this one as much anymore either because we have DU and DO now, so I think that's a little bit older of an acronym. DDE, so that's been shortened actually to DE. So direct endorsement means that an underwriter has earned the credentials to be a underwriter that is endorsed by Fannie Mae or Freddie Mac. I don't specifically know what all the criteria is because I am not an underwriter. I almost was once. I did all the training and then actually got recruited to go work for another company before I actually started underwriting. I did like lots of training, like a month of training and underwriting. But anyway, so direct endorsement underwriters are very valuable people. And they've done a lot of work in order to receive the credentials to be a direct endorsed underwriter. DELWRAP, the only reason I left this one in here is because there were some changes earlier this year in 2020. It is in regards to FHA loans. And so when somebody obtains a loan, not only are we trying to qualify the borrower, but we're also working to make sure that the collateral or the property being used as collateral is in good standing, right? So like it's not a hunk of junk, like it doesn't have like a lot of foundation issues, it doesn't need a lot of repairs. You can get those kinds of loans done. They have to be done in a renovation space. But one of the things that's really important, especially when you buy properties or when you're financing a property that is not a standalone, so it's attached in some sort of capacity, most of the time that there is an association that oversees the parts of the properties that are shared. And so when we're financing properties like condos or townhomes, not only does the property and the borrower have to be approved, but their HOA also has to be approved. Well, what came out earlier in 2020 is that we could do single unit approvals. So let's say the whole HOA wasn't approved, but we have somebody buying a property within this complex. You could do like a streamlined approval process. And DELWRAP is really the acronym for that approval process when they're reviewing the entire complex. It's really cumbersome, and I think that's why a lot of HOAs just kind of stopped doing it. It just got to be real bureaucratic, and it's a real detriment to the value of the properties that are in these HOAs that won't go through this process because it limits the amount of people who qualify to buy in that area. I digress. Back to the acronym sheet. So DO, we talked about that. That's Desktop Originator. That's the automated underwriting system for Fannie Mae. Debt to income ratio. Let's see, do we want to break this apart now? Let's break this apart now because we're going to do some mortgage math in a little bit, and I think it'll be helpful for y'all to know this now. Okay. Okay, debt to income ratio. It is the way it sounds, but there's a little bit more to it sometimes. Okay, so debt to income is the ratio of your income and or versus your debt. Now this is viewed in two different ways. The first one is called the front end. And then you have what's called the back end. So let's say we have an income. Let's say we have an income of $1,000. Y'all, I'm picking these numbers because it's going to be easy math for me. Oh, that seems really far. I hope y'all can see that. And here, let's not screen share for a second because I need to make sure that you can see that from here. Okay. So I'm just using like, they're a little bit unrealistic numbers, but it's more so because I want to make sure that I can do the math on the fly while I'm showing this to you, if I'm being really honest. Okay, so the front end ratio is going to be the housing expense. Okay, this is going to be the loan amount, the loan payment, taxes, insurance, HOA. There might be some other stuff. If it is, it's real, it's going to be real rare. Okay, but these are the four main ones. So let's say our total housing payment was $300. Okay, so our front end ratio is the $300 divided by 1,000, which is going to give us a 30%. Oh, good gravy, y'all. Hold on a second. 30%. Okay. Now, the back end ratio is going to be your housing plus your car, your credit cards, your student loans, and if any child support or alimony is going to all be calculated in the back end. Okay, so let's say we had another, let's just say we had another $200 here. Okay, so now we have 300 plus, sorry, we have 200 plus 300, which equals 500. Okay, simple math. We know that this is a 50% back end ratio, back end. Okay. We're going to talk a little bit about a little bit later what ratios for which type of loans are going to be within the parameters of approvability. But this is the front end and back end DTI. Okay, you will more often than not, you will just hear people call it a DTI, or you'll say the back end, you'll hear them say the back end is too high. So if you don't understand what that means, you're not going to know how to solve the problem. Okay, so that's the back end. This is the front end. All right, back to screen share. Okay, DU, we've already talked about that. Desktop Originator, Equal Credit Opportunity Act, which is ECOA. Really, the only time you'll hear this is when you're taking your licensing or your renewal class, but it is important not to discriminate. It's not taken lightly, so it's Equal Credit Opportunity Act. ECOA and Fair Housing are very similar. One of them has one more criteria than the other. I don't remember what the criteria is exactly. I know that one has 5 and one has 6. You only need to know this if you need to take your test. I mean, well, you should know it. But I mean, honestly, like I've had my license lit for 6 years and I don't remember. It's never come up. But if you haven't taken your test yet, just know that one of them is different. But things like, you know, race, sex, religion, right, see, I only know 4. There you go. Earnest money deposit. This is only going to be on purchase transactions. So an earnest money deposit is, how many of y'all in here have bought a car before? Okay, so you go to the dealership. Let's say you didn't go at 9 o'clock in the morning because we all know that financing a car takes all day. And let's say you were going to have to go back the next day to complete your financing. A lot of times what they want you to do is leave a check for $100 or $500, and then they pull the car off the lot and they don't sell it to anybody else, right? And so they hold it, and they have the potential to lose out, right? Because if you don't show up, then anybody who came in the 2 or 3 days didn't know that that vehicle was available to buy. So what you do is you put a good faith deposit down. Earnest money is the good faith deposit when you're buying a home. And we can use that money to apply towards the down payment or their closing costs. Like, so if they're doing a VA loan, they don't have a down payment, we would use their earnest money and say, okay, well, if you have $5,000 in closing costs and you gave an earnest money deposit of 2, then you only need to bring $3,000 to closing, okay? Oh, I always push the wrong button when I want to go back to screen sharing. Okay, earnest money. Excluded parties list system. I left this on here so that you guys could know, when I first started in the business, or like right in the middle, when I first came over to broker, let's put it there. When I first came over to broker, we actually had to verify that no parties of the transaction were included on the LDP or GSA lists. Okay, and an LDP and a GSA list are lists that were created by HUD, and I don't know who the other entity is, but basically they were people who had been found to have been acting inappropriately within the parameters. I don't know what the process is, but they were put on a list basically saying they are not allowed to be a party of a transaction for a loan that is sponsored by Fannie or Freddie or Ginnie, okay? So as a processor, we used to have to do the borrowers, the appraiser, the title company, the loan officer, ourselves as a processor, the escrow closer, our brokerage name, okay? We don't do that as much in broker anymore. Either the lender does it on their side, or it's done automatically now in some of the background checks. I'm not really sure, but the reason why I want to put it up here is because if you ever get an approval and they're like, hey, you need to verify that nobody's on the exclusionary list, then you've heard it before and you at least have some idea of what it is, okay? FDIC, the only reason that I have this in here is because that's different. Most of the wholesale banks that you use in a brokerage are not banks. They're not banking institutions, meaning they don't have places where somebody could open a checking or a savings account. And that would basically be one of the main criterias of them being insured by the FDIC. FEMA. Listen, we've all heard of FEMA. I think the biggest way that most of us would know FEMA is the fiasco from Hurricane Katrina, but it's the federal emergency system. The reason that this is important is FEMA is the one that designates when we have disaster areas. And so sometimes what happens is we'll be in the middle of a season of doing loans and all of a sudden a really bad weather comes into play and has done a lot of physical destruction to homes. And so the county or the city or the state may be declared by FEMA as and now I'm going to blank it. Now that I'm talking about it, I'm a blank. But basically they'll declare it like a disaster area. And so there's additional precautions that need to occur when we're doing any sort of financing in an area that might be declared a FEMA disaster zone. So FHA, Federal Housing Administration, we've talked about this. It's a type of loan, and it's an agency that oversees these type of loans. Federal Housing and Finance Agency oversees FHA. They're the big umbrella. Over FHA is the smaller umbrella. FHLBB, I don't know why I left that in there because I've never actually heard of it myself. FHLMC, so Federal Home Loan Mortgage Corporation. Listen, it's Freddie Mac, okay? If Fannie Mae and Freddie Mac, there's different variations of their acronyms. Listen, Freddie Mac always has a C in the acronym. That's all you need to know, okay? FICO, I'm sure you're all aware of what a FICO score, but FICO stands for Fair Isaacs Corporation. It's how your credit score is determined. Fair market value is the market value of your home, not necessarily what it costs to rebuild, but the cost at which the market will bear for a home to be bought, sold, or refinanced. Okay. FNMA is Fannie Mae. We've talked about that a couple times. Fannie Mae loans are backed by, or conventional loans can be backed by Fannie Mae. FRM, you'll see this mostly like on pricing sheets and stuff, but it's fixed rate mortgage. So a 30-year fixed rate mortgage, 20-year fixed rate mortgage, 25. For sale by owner, you will most likely hear this called a FSBO, is how we say it in real estate and lending, is a FSBO. Just means that a real estate agent isn't representing the seller in order to sell the home. First-time home buyer, FTHB. In conversation, people will say first-time home buyer. In paperwork, so whether it's a matrix or guidelines, you might see FTHB. Generally accepted accounting principles. The reason that I put this in is because if you're doing a self-employed borrower and they are like, let's say they're mid-year, and so we wouldn't have like a current pay stub for a self-employed, we're going to ask for some other documents that would give us the general heartbeat of the self-employed borrower, like mid-year in between tax filings. But those statements need to be prepared against generally accepted accounting principles. So you may see an approval sheet come out that says we need a balance sheet and a P&L prepared with GAAP principles. Ginnie Mae, Government National Mortgage Association. So we just talked about that. Ginnie Mae sponsors VA and USDA. Graduated payment mortgage. It's just, think about your student loans, right? So you can have an income-based repayment, which makes it longer before you pay it off, and a graduated payment just basically means you've decided to pay more on it every month to accelerate it being paid off sooner. Let's see. Housing Assistance Program. There are lots of acronyms for this. I can speak about the ones in Colorado. So we have CHAC, which is the Colorado Housing and Assistance Corporation. We also have CHAPA, which is the Colorado Housing and Finance Authority. So these are going to be mostly local, county, city, and state entities that usually assist with some sort of low-cost financing options for low-income people, okay? HCLTV, there it is. We just talked about that. Home equity conversion mortgage is a reverse mortgage. I don't know why we don't call it one or the other. It took me a long time to realize that they were one and the same. A HELOC, so The difference between a HELOC and a second mortgage. Excuse me, sorry, my throat is getting dry. So the difference between a HELOC and a second mortgage. So a HELOC is going to have its okay. So a HELOC is going to be more of like a credit card. It's going to be revolving. So for our example here, our borrower had a $15,000 line of credit, which is what makes it a HELOC. It's a line of credit. So anytime they make a payment on it, they still have $15,000 available to them, whether or not they use it, okay? If they have a true second mortgage, once they make the payment, let's say they make a $5,000 lump sum payment on a second mortgage, they don't get the option to reuse that back. It's much like a car loan where you borrow a set amount of money, you have a set amount of payments, and as you pay it off, and when you pay it down to zero, it will close. Where a HELOC is more like a credit card, right? So it's Christmas time, I go and charge up my Express card, I max that sucker out at $350, I pay the whole thing off, the balance is zero. Well, my Express card isn't closed, I can still use it, and that's what a HELOC is. HERA, we don't really hear about that very much. I presume after this whole COVID thing and forbearance for everyone, this is going to be a pretty common term when people get back into working again. Okay, HFA, Housing and Finance Agency, we just talked about that. California's is called Cal HFA. Let's see, HMDA, the Home Mortgage Disclosure Act. This is a compliance measure. You're going to want to remember this, and you're going to want to study it for your NMLS exam. Okay. Homeowners Association, Homeowners Association. I think most people are aware of what a homeowners association is. If you are not, it is an association that oversees the common areas and manages the rules, which is called the covenants and restrictions over a community, like nobody can paint their house fucking ugly purple would be something that would be determined by the HOA, right? Like you can paint it a certain purple, but not the ugly purple, not your grandma's favorite color of purple. It has to be like the cool purple, and it has to be pre-approved by the HOA. The HOA is also responsible for the maintenance of common grounds and also responsible for making sure that the HOA is insured properly. So an HOA oversees, like, if you have a condo or a townhome, right? So like, who pays for the roof on a condo building? Just the people who are on the top floor? No, everybody pays a percentage towards the roof. And it's the HOA's job to make sure that the entire complex is insured and maintains, right? So like, let's say a windstorm comes through and blows off a couple shingles. Well, whose responsibility is it, right? Everybody's going to end up fighting. It's not my responsibility, it's your responsibility. Because it's considered a common area or a common ground, it is managed by the HOA. Okay, so hopefully that makes sense. Higher priced mortgage loans. This is gonna be more in regards to like, when do the fees on a loan become so high it becomes predatory lending? I think we only had one loan this year get triggered for HPML, and it was because we were over 5% on the fees, which is really easy to happen when you have a low loan amount. Okay, so the lower the loan amount, just because the loan amount is low doesn't mean that an appraisal costs any less. So sometimes because the loan amount is low, you can really easily creak into this higher priced mortgage loan category, and it is just a trigger to review the loan for any sort of predatory lending. HUD is that Department of Housing and Urban Development. HVCC, so this is the Home Valuation Code of Conduct. This is actually going to be something that comes out with your appraisal. So once an appraisal is complete, it's got to be sent to the borrower, and it's got to be ran through some compliance, and it's got to have a whole bunch of other stuff done. Once the appraisal is complete and released to the borrower, the appraisal management company will issue you an HVCC certificate saying that the appraisal was done properly to the code of conduct, meaning that it was ordered through an appraisal management company. There was no influence of value by way of the lender or the realtor or any of the parties involved, okay? Interest only, it just characterizes a type of loan where the payment is only, is applied to the interest of the loan only. Okay, IP is an investment property. You're not always going to see this IP though. Most of the time you're going to actually see it like INVST or something like that. IR is interest rate reduction refinance loan. This specifically is in reference to a VA loan. It's called a streamline loan, so it's available for FHA loans. It's called a streamline loan. In VA, it's called an IRL. It's a very simple refinance. We don't collect any information regarding income or anything like that. It truly is to quickly turn the loan for a lower interest rate should the borrower qualify for a lower interest rate. Okay, so that's an IRL, and that pertains only and specifically to VA loans. Everybody knows about the IRS. LAP is a lender appraisal processing program. This is done for VA loans. It's an acronym that is as it pertains to VA appraisals. So remember when we were talking about the exclusionary list? Okay, LDP is the limited denial of participation, is one of those lists. Okay. LE, the loan estimate. So the loan estimate is our good faith estimate that so it used to be called the good faith estimate. In October of 2000 and well, now I'm second guessing myself. I want to say 18, but now I think it's 15. Anyway, 1 October, a few moons ago, our disclosure process changed to what the environment is now called TRID. So TRID describes our disclosure process for home mortgage loans now. Our job is to make sure that a borrower, oh y'all, this is how it's going to be. Okay. Our job is to make sure that a borrower receives a loan estimate, which is going to be our best foot forward on telling a borrower what all the financial implications are going to be to do this loan. What's it going to cost? What are you going to have to pay for? How much do we need to set aside for your taxes and insurance? What is the county going to charge to record these new documents showing that you're the owner or that this is the new loan that you're getting? Okay, so the loan estimate is really our best foot forward to inform and educate the borrower on what the transaction is going to entail. Okay, LIBOR, talked about LIBOR. LLC defines a type of company. So this would be more as it applies to self-employed people, so a limited liability company. Ooh, loan level price adjustment. You will deal with this every day of the week. Okay. I did not understand this for a long time, not because I'm not uneducated, but because nobody taught me, and I just used the computer system and didn't really understand what it was doing. So a loan level price adjustment, I always start to giggle when I talk about these because at some point you're going to have an interaction with somebody who, or a borrower who, or if you're a processor and you're processing loans, somebody is going to be like, hey, I need a price for Mr. Jones's file, and he's got a 720 FICO and he's 75% LTV. I will tell you right now that is not nearly enough information for us to be able to quote a rate. There are several characterizing points that determine how somebody prices out for an interest rate. Okay, so we're going to have the loan to value.
Okay, we're gonna have their FICO score. We're gonna have the type of loan. And then the kind of loan, like, is it a purchase? Is it a refi? If it's a refi, what kind of refi? Okay, this is gonna be like, is it conventional? Is it FHA? Okay, and then there was one more, but I lost my train of thought. Anyway, you get the point, right? Okay, so for every one of these, so the higher the loan to value, the more risky it is, the more it's gonna cost, okay? So you're gonna get what's called a loan level price adjustment, where you're gonna take a hit or a charge. Okay, they're gonna charge you this because your loan to value is high, okay? Same thing with FICO. The lower the FICO, the more risky, the more expensive. Okay. Same with this. Same with any of these. They all carry their own risk profile. So whatever the charge is the loan level price adjustment. Okay, that's the loan level price adjustment. And these can vary bank to bank. That can vary bank to bank. Some of them are as prescribed by the backing entity, and then some of them are as prescribed by the bank. Okay, loan level price adjustment. Okay, letter of intent. The only time you might see a letter of intent is if somebody's starting a new job and they've gotten an offer letter. Okay, and we can qualify somebody with an offer letter. It depends on what kind of loan, what type of loan they're getting. We'll determine what other additional documentation we would need in order to close the loan. But a letter of intent, you could qualify somebody to do a loan based on their offer letter from an employer. LPMI is lender paid mortgage insurance. I'm not going to dive too much into that today, but it is talking about the insurance on a loan, the mortgage insurance on a loan, because we're going to jump into that a little bit more on another training. We've talked about loan to value, mortgage-backed bond, and mortgage-backed securities. The one you'll hear the most talked about is MBS, really. And we'll get into this a little bit more down the road, but it's basically I'm trying to think, the thing that people would know the most. So let's say if you've ever had a 401k, you guys, I hate this part. If you've ever had a 401k and they're like, designate, tell us how you would like to invest your retirement money. You want to go a little bit risky or a lot of it risky, right? And they ask you to like make these decisions about where to put your 401k money, and you're like, I have no working idea. Like, I don't know anything about investments, okay? Well, a security instrument would be, let's see, the simplest way to put this would be like something to invest in that was backed by mortgages. Okay, so you all know that a mortgage has an interest rate on it. And so if you invest your money with a bunch of other people and buy a big bundle of mortgage-backed securities, you're going to earn a very prescribed and predictable amount of money in there. It's not going to be a lot, right? Because it's not very risky. But you might choose to do that for the guaranteed gain over the long haul. You may invest some of your money in that. But anyway, that's what a mortgage-backed security is. Okay, mortgage insurance. The best way to describe this is pretty much everybody owns a car. And so it's like when you finance a car, and if you have a loan on the car, then you're required to carry full coverage insurance. That way, if you get in an accident and the car is totaled, the insurance doesn't just give you, the borrower, the money, and then you're like, well, I got to go buy another car. I can't pay this car off, right? The money has to go back to the bank to pay off the loan. And mortgage loans that do not have 20% in equity are going to have some sort of mortgage insurance on them. This is going to vary loan to loan, and it is determined a little bit by the profile of the loan and the profile of the borrower.
but just for example, but like when mortgage insurance would come off on like a conventional loan would be as soon as the borrower has 20% equity in the property. Let's see, a mortgage insurance certificate is just that. When you get the mortgage insurance, there are lots of companies that provide that mortgage insurance, and then once it's all approved and done, you get a nice little certificate that goes in the file. Don't worry about it as a processor. The mortgage lenders do that. The banks do it. A mortgage insurance premium is just the premium for the insurance that we just talked about right here. No, NCO is no cash out refinance. This is a little bit outdated because now there's not really a no cash out option anymore. It's limited cash out because if people roll in their closing costs, then technically they're getting cash out. So that's still considered a rate and term, but it's just limited cash out now. NPI, so non-public personal information. The reason, so I'd have a hard time recalling when I've actually seen this acronym, but the verbiage here is important. Every file is going to have a disclosure regarding privacy and what a company does with their information. Do they sell it to other companies that may have an affiliated interest in the data? They have to tell you if they're doing that or sharing that data. As processors and loan officers, we are bound by our regulatory agency to handle non-public personal information in a secure fashion. So non-public personal information might be more than just somebody's birth date, but social security number, things like that would fall under the category of non-public personal information. Okay, NOO means non-owner occupied, right? So it's describing the occupancy of a property, meaning how is the borrower related to the property? Are they going to occupy it as an owner, or is it going to be non-owner occupied, meaning is it a rental? Okay. Notice of value, this is also as it pertains to a VA appraisal. It's going to be once an appraisal is received by the VA and has passed all of the quality parameters, they're going to issue a notice of value once the appraisal is complete. P&I is principal and interest. You will hear this a lot. You will also hear the next one, PITI. So the principal and interest is once you determine the amount of loan over the number of months, which equates to the number of years. Once that is, okay, time out. Oh, time out. All right. Let's just do this. Okay, so if a borrower is borrowing $100,000, okay, for 30 years, which is 360 months. Okay, let's say the payment is at 4%. Okay, so they're borrowing $100,000 at 4% for 30 years, which is 360 months. Let's say that payment, which includes the principal to pay this plus the interest, is $300. Okay, so that's the PI. Let's say the taxes on the property are $1,200 a year, so that's another $100, and insurance is $600 a year. Okay, so that's another $50 a month. So the total payment with taxes and insurance, or PITI, okay, PITI is $450. Now, I always got caught with these damn acronyms that I didn't know what they meant. And I felt so silly because I would hear them 5 and 6 and 7 years into this business. And I would be like, I'm the only one here that doesn't know what this means. Like, for example, I went to work. So I got into mortgage in 2005. I was in through mid 2007. I spent 2007 and 2008 getting hired and then getting laid off. Got back into mortgage in 2012. I was recruited to go work on a mod project. And then I was recruited to go work for a bigger bank. They were launching a web-based software. And you all had a lot of success in mortgage at this point, lots of success in mortgage, really high producer, top 5% of my company. So I was a top producer at this new company. Myself and one other gentleman on our team, not only were we the top on our team, we were the top 2 on our entire floor. And then I think we were in the top 5, and I say we because we had the same amount of production. And then I think, man, I wish I could ask him, because there was 2 floors. There was the 4th floor and the 8th floor. And I think we were like in the top 5 or the top 10 out of like 300 people between the 2 floors. So anyway, I tell you that because I was there probably like in my 2nd month and something happened. I don't know if the system went down. I think the system went down. And I was trying to like manually process this loan outside of the system, still trying to get my job done right, trying to be resourceful. And I didn't know how to get the EOI because you just push a button and a couple days later it shows up and you get an email and they're like, oh, the EOI is in. And so I remember going over and asking, like, I didn't want to ask anybody on my team. And so I went and asked like this person on a neighboring team, and I was like, hey, so hey, who did your last EOI? Like, what was the name of the company? And they were like, what? Like, what? Like, do you not know? You don't know what EOI is? And I was like, I mean, like, yeah, I do, but like, what is it? And they were like, evidence of insurance. HOI. Oh, you mean HOA, homeowners. And yeah, I know what homeowners insurance is. So sometimes it really wasn't that I didn't know. It's just that I didn't know what it was called at that particular company. And so once I had that experience, I really started to quash a lot of my insecurities about being in this job because I knew what I was doing. I just didn't always know what different companies called it. Okay, so all of that to tell you that you also have what's called, let's do this. You may see PITIA, and the A stands for any association news. So let's say this is a townhome and they also pay $150 a month for the HOA, okay? PITIA. Going back to screen share. Private mortgage insurance. I think we've hit that one to death already, talking about mortgage insurance paid outside of closing. This is something that you will deal with on every deal. It is any part of the transaction that was paid prior to the closing. Okay, so an appraisal would be paid prior to the closing or paid outside of closing if it was paid for by the borrower. Okay, insurance policies on refinances. Like if they're currently escrowing on their current loan, then the insurance premium, whenever it renewed, was already paid by their current lender and it was paid outside of the closing we're doing right now, POC. Prepayment penalty. We don't really have these anymore. HUD, so planned unit development. Most homes nowadays are in a PUD. And really what a PUD is it's like a special zoning district. So if you were to go, I got a really good education in this in the last year and a half on a property that we bought. But most counties, the zoning prescribes how big a lot of land has to be in order to be considered residential for residential zoning. Okay, but what happens is when a builder comes in and builds tract homes, they go to the zoning department and they request a special variance for the lots to be smaller, obviously, so they can build more houses. But that would be a planned unit development because that entire area or that entire like neighborhood is built under the specified planned building request to the county. So for example, like in Jefferson County, I think residential lots are prescribed to be like between 0.10 and 0.25 acres. But in a lot of the tract home areas, the lots are like 0.5 acres or 0.25 acres or 0.10 acres, right? So the builder would have had to go to the zoning department, and then the county might have said, yes, you can do that, but you have to make sure the streets are this and this is that, and that the homes do this, and they have to be, you know, so whatever that agreement is between the builder and the community may mean that they have to establish some covenants and restrictions and rules, especially if the PUD is built over any sort of public utilities or easements, meaning that the city has to maintain access to these things. Like I just know that the neighborhood right by where we lived had a big aquifer that ran down from the Colorado Rockies that supplied water to the Front Range. It actually literally ran underneath our property. It was a 2-foot by 2-foot cement water, I want to say waterway, but I don't think that's the right terminology. But anyway, it literally ran through our property, and it came through the neighborhood that was behind us. And so there were some restrictions and covenants about what could and couldn't be done in certain areas because this aquifer ran underneath our properties. Anyway, I digress, but that's what a PUD is. Rural development, this is going to be properties that usually are outliers of major suburban areas, okay? And they're going to be considered more of like an agricultural or rural, and they can be eligible for different financing. Let's see, REO, real estate owned. This has 2 different places that you will see this on the loan application. If a borrower has more than 1 property, you're going to make sure that all properties are listed under the REO section, real estate owned, okay? REO is also in reference to properties that are held by banks via foreclosure. Okay, these are the properties or the real estate owned by the bank. Either way, REO is REO, but those would be the 2 ways that you would hear it. RESPA, the Real Estate Settlement Procedures Act. Listen, this is a huge compliance. This is an everyday compliance working area. If you are, not if, let me backtrack that. This is something that needs to be top of mind working in this industry. If you are a junior processor or a level 2 processor, you really need to be consulting and talking hand in hand with your loan officer regarding any of the fees associated, right? Settlement procedures. So any of the fees associated with doing the loan. If you're a third-party processor, you already know this stuff. If you're a new third-party processor, you've got to learn this stuff because there are fines and fees charged if a loan is not properly disclosed. And on some of those fees, you pay the difference penny for penny. Okay, so this is an everyday operating area. It's kind of like, listen, if you were a medical provider, right? If you were, let's say you were a nurse, like there are very specific times you got to have your stinking gloves on, okay? You can't be outside of protocol of not having your gloves on in certain things. Like first thing that comes to mind is the OBGYN office, okay? Right? Always got to have the gloves on. I digress. RESPA, that important. Rural Housing Service, again, that's going to be USDA or rural agricultural type housing. Special flood hazard area. Okay, so you don't really see this, like in the areas that I'm licensed in, we don't have a lot of flood zones, okay? There are going to be other states and areas that are much more familiar because they're in floodplains or flood zones. So I don't specifically see SFHA very much. What you will see on every loan is ran through FEMA's flood map. You put in the address and it tells you, and then you pull a little certificate down. It's done on every loan.
I don't think, I haven't had to check this in years and years and years. It's all like a lot of it's technology and the lenders do it on their backside now. So not a whole lot to worry about, but every property is going to have a flood cert. We call it a flood cert hold on it. They're going to verify that property against FEMA's flood zone map to see if it lies in a flood zone. Because if it lies in a flood zone, then you got to carry flood insurance. Okay. Truth in Lending Act. I just heard the TikTok in my head that said, some of y'all gonna be real mad at me, right? There's gonna be some compliance people that are gonna be like, girl, listen. The Truth in Lending Act, like the reason it probably doesn't like really, it's not something that I super concern myself with because I'm a really honest person. And I do my very best to make sure that my borrowers are educated and give them the information and just tell them how stuff works. Like it is what it is. There's a lot of things I can't change about the process. And so the thing that you need to know about TILA is you better know about TILA when you take your test. And then after you take your test, don't worry about it too much. Okay? Capiche? All right. Taxes and insurance, we talked about that right here, right? Taxes, insurance, part of the PITI. TPO, brokers are TPOs. We are third-party originators. We're going to originate that loan and then we're going to take it to a lender and they're going to underwrite it, okay? A regular loan, I don't even know, like regulars, I'm tripping up over the word regular, but like if a loan originator for a direct lender, they're just a loan originator because they only originate for the company that they work for. Upfront mortgage insurance premium. So the UFMIP really describes the insurance that is collected on FHA home loans. Okay, it's 1.75%. It's right on top. There's no getting out of it. It's an insurance that is collected on all the loans. It goes into a bank that is there to handle man, I'm really trying to simplify this. It's like your emergency fund, okay? Like let's say you siphoned $175 off the top of every check that you got and you just put it over in an emergency fund for a rainy day. Think of it like that. So upfront mortgage insurance is put into like a rainy day fund for FHA. Because FHA loans are more risky, they're at greater risk for default. And when default occurs, in whatever fashion, so default is if somebody doesn't make their payment. And so when somebody doesn't make their payment, the entity still has to make the payment to the investor. So just know that the insurance premium like that's charged on these like goes in a rainy day fund, and we'll just leave her there. And we'll dive into, so some of this stuff I'm going to leave her there because I know that it's coming in some later trainings. Okay. If you have more questions about it, like at the end, just unmute your mic and you can ask me and we'll dive into it. But we're almost done here. So URAR, okay, Uniform Residential Appraisal Report. You won't ever hear, like, I shouldn't say ever. I always get hesitant to say never, ever, or always. You're not, in the majority, like extreme majority of cases, you're not going to hear an appraisal ever referred to as the URAR, okay? You're more likely going to hear an appraisal referred to by the number. The number tells you what kind of report, or the number for the report for the investor that you're doing the loan for. So for example, a conventional appraisal report is a 1004. The same for Fannie Mae, the same report for Freddie Mac is a 1073 or 1075, okay? URLA is Uniform Residential Loan Application. You almost never will hear it called a URLA, you will hear it called a 1003, okay? You will hear it called a 1003. 1003 is a loan application. Okay, we've talked about the VA, which is the U.S. Department of Veteran Affairs.
Verification of deposit. So anytime a borrower has a large deposit outside of what appears to be a paycheck, we're going to need to verify what that is. Okay, so this used to be more common. You would send a form to the bank and they would fill it out. That's not as common anymore. Most times now you're going to ask the borrower to verify what that deposit was. They're going to have to give you a copy of it. You know, with technology nowadays, this stuff is really easy to come by on your online banking. Verification of employment is a VOE. The different acronyms dictate what kind of verification of employment it is. So you have to be really careful working with other different banks. Use these acronyms very loosely. And so you may think that a VOE is one thing because that's what it is at Bank A, but then it means something different at Bank B. So you just have to clarify what you're getting. But basically a verification of employment is verifying dates of employment and job description. If you need a written verification of employment, it's because we also need to verify the history of earnings, of income, especially if the borrower earns something other than a base hourly or base salary. Like let's say they earn commission, overtime, or bonus, or what's really common in the medical industry of like shift differential. So it's like a pay above and beyond their normal hourly or base pay rate. Verification of mortgage is verifying. So you'll see this a lot. Like let's say a borrower calls, let's say they call the beginning of February to refinance, but their mortgage trade line hasn't updated yet for February, right? Because it's like, maybe it's like the 3rd of February. And let's say we don't close the loan until March. The bank is going to want to verify that the February payment was made. And they're going to ask you to get a supplement for a verification of mortgage. That's what that means. Sometimes it can be like an old mortgage, especially if somebody was in a bankruptcy or a foreclosure situation, or most times it's going to be a bankruptcy because a bankruptcy, it is a protection of the borrower. So sometimes what happens is mortgage companies and debtors stop reporting on credit because it can be considered an act of collecting, and the bankruptcy is a protection from the act of collecting. So sometimes what you have to do is if somebody's inside of a bankruptcy or recently discharged, you have to go get a verification of mortgage. How was the mortgage paid in the last 12 months? Same thing with verification of rent. If somebody was renting before they were buying, and this is going to, whether or not you have to do this is going to be lined out on your underwriting findings, okay? And then yield spread premium. So if you remember, so yield spread premium is what a rate pays. Here, let me take a drink and then I'll dive into this because this is going to be like an everyday thing that you're going to want to know. Okay. So the common language is going to be YSP, yield spread premium. Okay, so we're going to have a rate sheet. Let's say this is our rate sheet. Okay, and then right next to it, you're going to see what the rate pays. Okay, and that is the yield spread premium. So let's say 3% is paying 2. This is paying 2.25, 2.375, and this is paying 2.5%. And then remember we had all those loan level price adjustments, right? So we have all our LLPAs. So, you know, for our loan, we just were talking about it. So we had for the loan to value and the FICO and the kind of loan, let's say we had a total of 1.125, okay? Our total loan level price adjustments was 1.125. So we're going to look for the rate on the rate sheet that covers the loan level price adjustments. Okay. Now, you have another thing that's called your compensation, and it's lender paid or borrower paid. I spend like almost a whole day
going over the difference between lender paid and borrower paid, so we're not going to jump into that now. But for this specific conversation, we're going to assume that this rate sheet is lender paid. So it's already taking into account the compensation that's being paid, okay? And so let's say that this rate covers this, so we have a difference of 0.875. So the borrower would be getting a credit, right? So we have this much yield spread premium. We have this much, so this is like a positive. Actually, the way you're really going to see it on a rate sheet is this is going to show a negative, and this is going to show a positive, and then this is going to be a negative. And so for that same example, right, it's, but let's say the loan amount's $100,000. You would take 100,000, move the decimal over 1.2 because it's of 100. Remember, a basis point, this is 0.875 basis points is the credit. You have a $100,000 loan, you're going to multiply 100,000 times 0.00875. So I'll do that really quick. 100,000 times 0.00875. So this has a credit to the borrower of $875, right? Because we had credit and a charge. So it's like going to the grocery store, got $2, bought me a pack of gum. I owe them $1 and a nickel and 2.5 pennies, or $1 a dime and 2.5 pennies, right? They're going to give me back my 87.5 cents. Okay. So this column right here is the yield spread premium. That's the yield spread premium. Okay. And I think that is the last one on here. Just double check. Yes, so that is the last one on here. We have just a couple more things to talk about really quick. Let me just get my sheet out. I was all fancy and got my sheet out, but I don't know what to do with it. Oh, hold on a second. Let me find it. Okay, so we're going to talk about mortgage math, and then we're going to talk about some basic loan matrices. Okay, so mortgage math. We've talked a lot about mortgage math already with loan to value and debt to income. Okay. Let's see. All right, hold on one second. I gotta find this paper because I'm so afraid I'm not gonna tell you something that I wanted to tell you. So give me just 1 second. Oh my goodness, I can't find it. I don't know what I did with it. All right, well, we're just gonna go with this. Okay, so you have a conventional loan, you have an FHA loans, you have USDA loans, you have VA loans, and then you have what's called non-QM. QM means qualifying mortgage. These are all qualifying mortgages, okay? There is not only because they have servicers, So the example that I give a lot when I'm talking about this is like, these are all tennis shoes, okay? They're all tennis shoes. They're just different kinds of tennis shoes, okay? So like, let's say you have like Nike and and I don't, so don't take your emotional baggage about these brands into me telling you that certain loans are better than another. Okay, so you got to put your emotions aside of this. Wait, let's see. Like this is Puma. Let's see, like these are, I think it's like RBX. It's like the generic Reeboks or something like that. And like, let's say these are Crocs. Okay, and these are work boots. And then these are like, I don't know. I don't know what these are, right? Nike only makes shoes a certain way, right? And it has to have a swoosh on it, and they have to come in the orange box, right? That's Nike. And then Puma, and that's like, say like this is like Fannie Mae, okay? And then Puma is like Freddie Mac. And I always use Puma as Freddie Mac because Freddie Mac, it's very challenging to get Freddie Mac to approve a loan profile if the borrower's back end is above 45% debt to income, right? And so now you all kind of have an idea of what I just said. But I always laugh because when my son was in high school, Pumas were like all the rage, right? Pumas are very narrow shoes. And on my dad's side of the family, we have really wide feet. So like I inherited the Fred Flintstone feet and I passed those on to my son. His dad had very narrow feet. He did not get those feet. And I tell you what, like the couple times that we tried to buy Pumas for him, we had to buy him like a size and a half bigger just so the damn things would fit, right? But Freddie Mac is a little bit more skinny on their approvals, so that's why I do that, right? But they're all shoes. They're all shoes. They all have soles. They all have shoelaces, right? They all have similar characteristics, but they're all going to be a little bit different, and their brand is going to tell us, like, what are the characteristics that make them different, okay? So, as a general rule, so I'm filming this during COVID, and the reason why I'm telling you, like, I want to teach you this based on the general rules is because we have what's called an overlay where banks get to put additional rules of what qualities a borrower has to have in order for them to do the loan, okay? So that's called an overlay. They're going to take the rules as defined by the entities, Fannie Mae, Freddie Mac, Ginnie Mae, VA, and they're going to say, well, we know that VA does not have a credit score requirement, but in order for us to do the loan, you have to have a minimum score of 550. Okay, the bank might say this, and that would be an overlay. Okay, so first things first. Now, conventional has a minimum FICO score of 620. Okay, FHA you can go down to 500, but from 500 to 579 you have to put 10% down, and it has to be your own money. Okay, at 580 and above you can put 3.5% down. USDA, I think, oh, I haven't done one of these in a while. I should pull up my matrix. There is a minimum credit score requirement. VA has none. And non-QM, I've seen banks go down to 450. Okay, they get to make their own rules in non-QM. The investors get to decide what they're going to lend on. Okay. Now, along with this, is everybody okay? Can I erase this really quick? Or everybody's okay with this? Okay. So along with this, along with the score requirements, you're going to have some parameters. Sorry, my kid's getting a little too loud in there. of debt to income ratio requirements. So typically on conventional, you can get approval higher than this, but 3149.99, and you can get approval like 35 and 40. It's gonna, so this is the front end, this is the back end, okay? And this is for Fannie, and this is for Freddie, okay? This is gonna be case by case, but typically we're gonna wanna be, you know, the lower your front end ratio can be, the better for likelihood of approval. Okay, Freddie Mac really does not like to approve loans over this 45 on the back end. And it used to be, and I haven't tried this in a while, it used to be that you could go up to 45.49 before it would round up. So you could squeak out just a little bit more in there. I don't know if they fixed, I don't know if they changed that or not, fixed it like it was broken, if they changed it or not. Okay, USDA has some really strict, like 2941, real strict guidelines here. You can go up a little bit higher, I think 3143 with a 680 or higher FICO. Okay, 29 on the front end, 2941. VA has none. What you will see is it will say per AUS, meaning as long as when you run it through DU, as long as you get approved eligible findings, which we'll go over that at a later date, as long as you get approved eligible findings, the loan is approvable. And I mean, listen, okay, I'm just gonna say it. It's not for debate. It's not what I think about it. I'm just gonna say it because I'm teaching you this class. But we've seen VA do approvals up to like, I mean, I think I've seen people say 65, 70% on the back end, but it might give that approval if our veteran friend has, you know, $50,000 in the bank. So, you know, it's not, I don't want you to think that like all VA loans are going to be approved at this, like pretty much above 50 or 55. It's going to be case by case. But here's another overlay. Sometimes lenders will say, we aren't going to do a loan for a veteran above a back end ratio of 50 to 55. Okay, makes sense? All right. FHA. FHA fluctuates, and I will tell you that you will get a different approval on FHA for loans above 620 and loans below 620. So below 620, you want to try and stay at this 3143. Okay. Above 620, you typically can get approval from like 45 to 56.89. And it just depends on how high the score is and their overall credit profile. Do they have money left in the bank after the fact? There's a few things that go into it, but I will tell you that at 619 and below, unless they have a lot of money in the bank, like 1 to 3 months of reserves or 3 months of reserves, this is going to flip to a refer. Okay, and you can still get the loan done, but then you have to have compensating factors, and we go over that in another training. Okay, so FHA, this is the front end, this is the back end. So let's say you're running underwriting and you have a loan that's a refer, but let's say this is 34. Okay, some things that would bring this down would be a lower rate, or lower insurance, or a lower loan amount, which means the borrower might have to put more money down. Okay, lowering the loan amount, you're probably better off taking a certain amount of money and just buying the rate down, because lowering the loan amount doesn't have as big of an impact. But in FHA, so, oh, here's a little trick I want to teach you. If you get in that situation where you're having a hard time getting a loan approved at 3.5%, 3.5% down on an FHA, right? Because their credit score is above 580 and higher, okay? So FHA has two insurances. They have the upfront mortgage insurance premium, UFMIP, 1.75% of the loan amount. But there's also a monthly MI or mortgage insurance, and it's a percent, so it's calculated as 0.85 is the percentage in order to calculate what that mortgage insurance is going to be. However, if they put 5% down on the FHA, okay, so now they're putting 5% down, which brings the loan amount down, but also this MI goes to 0.80. Okay, so how much is the difference? So 100,000 times 0.015. Okay, so for every, it's another, for every $100,000 of loan, it's another $1,500 in down payment to get to 5%. So if the loan amount is 200,000, then they need another 3,000. Okay. But what you have to look at is with this $1,500 instead, how much can I buy the, let's say this was at 4%, okay? And let's say to get to 3.75, it costs $800. Let's say the cost to buy that rate down was $800. So you really have to look at the options of this $1,500. Is it best applied getting the loan down to 5%? If we get it down to 5%, does that change our pricing? Does that get us a lower rate? Or do we take $800 and just buy the rate down? Okay, those are some tricks of the trade. Oh, okay. That is about, I think we're just about out of time for today. I will use a lot of the same references in every class because it's really important, no matter where, to me, no matter where somebody comes in, that they understand the philosophy of which I'm teaching and I'm training, right? And so what I'm trying to do is, you know, if you've ever been on a plane and you know, you've had snacks and you've had drinks and you're kind of sitting there, and then all of a sudden you hear the bing, 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 and then you hear the pilot come on and say, or it goes bing, 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 and then maybe the flight attendant will come on and say something along the lines of, please notice the captain has turned on the lights for the fasten your seatbelt sign, and then a short time thereafter the captain comes on and says, flight attendants prepare for landing, right? And somebody comes on and says, we're 200 miles from our destination and we're going to begin our descent down into the airport of wherever we're landing. Okay, so right now we're real high level. We're still coasting really high. As we go further into the trainings, we're going to land the plane, which means we'll dive into these subjects a little bit more in detail, answer some more questions, and give some more examples. We'll pull up some real rate sheets. I specifically pull up a really, really old rate sheet that's like not even in existence anymore because I don't want to get in trouble. It's considered proprietary information, but I do want you guys to see that, okay? So I'm gonna do my very best to share that knowledge with you and bring that plane down for you, okay? So thanks for hanging tight with me for that bit of time today. I look forward to seeing you next time.